Hello everyone and welcome back to the channel. Today we need to talk about something that's been making waves across financial markets, something that's got investors, industrial manufacturers, and everyday people buzzing with concern and excitement. I'm talking about silver, and more specifically, the question on everyone's mind: when does silver actually run out? You've probably seen the headlines: silver shortages, empty shelves at coin dealers, mints running out of inventory, China restricting exports, prices spiking to $117, then crashing to $78 in a single day. It's chaos out there. And if you're watching this video, you're probably wondering what's really going on and what it means for your money, your investments, and your future. Here's the truth. We're not just talking about some minor supply hiccup. We're talking about a structural deficit that's been building for 5 consecutive years. Think about that, 5 years, where demand has exceeded new mine supply every single year. And it's getting worse, not better. In this video, I'm going to walk you through exactly what's happening in the silver market right now. We'll look at the physical shortage evidence that's piling up from Australia to Canada to the United States. We'll examine what happened during that massive January 2026 crash, when silver became what people are calling a meme metal. We'll talk about China's export restrictions and what they really mean. And most importantly, we'll discuss what you need to know. By the end of this video, you'll understand why some of the smartest investors in the world are calling this the biggest opportunity in precious metals history, and why others are warning that we're heading toward what Mike Maloney calls Unobtanium, a moment when physical silver becomes nearly impossible to buy at any price. So let's dive in, because time might be running out faster than you think. Let's start with the foundation of this entire story. The silver market has been running a deficit for 5 consecutive years. What does that actually mean? It means that every year the world has been consuming more silver than miners can pull out of the ground. Every year we've been drawing down existing stockpiles. Think of it like a bank account. If you spend more than you earn, you're drawing down your savings. That works for a while, but eventually your savings run out. That's exactly what's happening with silver right now. The deficit isn't small either. We're talking about massive gaps between supply and demand. Industrial applications are consuming silver at record rates. Solar panels, electric vehicles, electronics, 5G infrastructure, all of these technologies require silver. And as the world pushes toward green energy and advanced technology, that demand keeps climbing higher and higher. Meanwhile, new mine supply isn't keeping up. Finding new silver deposits takes years. Developing a mine takes even longer, and many of the world's largest silver mines are aging, producing less silver each year than they did in the past. Some are reaching the end of their productive lives entirely. This creates a perfect storm scenario. Demand rising, supply falling, stockpiles being depleted, and investors around the world starting to wake up to this reality. Now you might be thinking, if there's such a huge shortage, why hasn't the price gone through the roof permanently? That's a great question. And the answer brings us to one of the most controversial aspects of the silver market: the difference between paper silver and physical silver. Here's where things get really interesting. When most people think about buying silver, they think about coins, bars, and physical metal you can hold in your hand. But in the financial markets, most silver trading doesn't involve physical metal at all. It involves paper contracts. These paper contracts, like those traded on the COMEX exchange in New York, they're settled in cash instead. This system has allowed financial institutions to effectively create silver on paper that doesn't exist in the real world. Think about it. If you can sell a contract promising to deliver silver without actually having the silver in your vault, you've just created synthetic supply. And that synthetic supply affects the price, even though it's not real metal. This is why we're seeing such a massive disconnect right now. The paper market says silver should be trading at a certain price based on all those contracts. Something very unusual happened. The COMEX raised margin requirements, meaning traders had to put up more cash to maintain their positions. The London Metal Exchange went dark, with technical issues. HSBC systems went offline, and then silver crashed 35% in a single day. But here's what's fascinating. While the paper price was crashing, physical dealers were reporting they couldn't keep inventory on their shelves. People were lining up to buy at the lower prices. The disconnect between paper and physical had never been more obvious. Some analysts, including those who've been watching this market for decades, believe we witnessed something extraordinary that day. They suggest it wasn't just volatility. They believe it was a coordinated reset of the paper market, designed to shake out weak hands and allow large institutions to cover positions before the physical shortage became undeniable. Now, I can't prove that. Nobody can. But the timing and the sequence of events certainly raised eyebrows across the investment community. Let's move from theory to concrete evidence. What's actually happening on the ground at precious metals dealers around the world? The situation is becoming increasingly difficult to ignore. Reports are flooding in from Australia, Africa, Canada, Vietnam, the United Kingdom, and the United States. The story is remarkably consistent across all these regions. Empty shelves, delayed shipments, back orders stretching out for weeks or even months. This isn't just one country or one dealer having supply chain issues. This is a global phenomenon. Let's look at some specific examples. The Royal Canadian Mint, one of the most respected government mints in the world, has been out of key silver products for extended periods. The Perth Mint in Australia, another major producer, has faced similar shortages. These aren't small operations. These are massive government-backed mints that produce millions of ounces of silver products every year. In the United States, major dealers like SD Bullion have reported inventory levels dropping to critically low numbers. One report mentioned they had fewer than 2,300 units left in stock. For a major national dealer, that's an incredibly small number. It's like a grocery store having only a few loaves of bread left on the shelf. But it's not just the big dealers. Small local coin shops are reporting the same problems. Customers come in looking to buy silver. The shop owner checks with their wholesaler. The wholesaler is out of stock or has limited availability. The customer either pays a much higher premium or goes on a waiting list. This physical shortage is creating what economists call a two-tier market. There's the paper price you see quoted on financial websites, and then there's the real price you actually have to pay to get physical metal in your hands. That gap between the two has been widening dramatically. I spoke with several dealers while researching this video. They all told me the same thing. They've never seen demand like this. Even during previous bull markets, they could usually source inventory if they were willing to pay a little more. Now, at any price, inventory is becoming scarce. This brings us to Mike Maloney's concept of unobtanium. He first coined this term during the 2008 financial crisis, when physical silver became nearly impossible to buy, despite the fact that the paper price was relatively low. You could see a price on the screen, but you couldn't actually buy silver at that price. It had become unobtanium, something you theoretically could obtain but practically couldn't. Many analysts believe we're heading back to that scenario, and this time, it could be even more severe. Now let's talk about a development that's added fuel to an already raging fire. On January 1st, 2026, China implemented tighter controls on silver exports. This might sound like a minor policy adjustment, but when you understand China's role in the global silver market, you realize this is a massive deal. China is the world's second largest exporter of silver. They produce enormous quantities of silver as a byproduct of their mining operations. And for years, that Chinese silver has flowed freely into global markets, helping to meet worldwide demand. But things have changed. China announced new restrictions on how much silver producers can ship out of the country. They're essentially keeping more silver within their borders. And when a major supplier suddenly restricts exports, the impact ripples across the entire global market. Why would China do this? There are several theories. Some analysts believe China is hoarding silver for its own industrial needs. Remember, China is the world's largest manufacturer of solar panels, electronics, and many other silver-intensive products. Keeping silver domestic supports their industrial base. Others believe it's a strategic resource play. Silver has monetary properties. It's been used as money for thousands of years. Some suggest China is accumulating silver as part of a broader strategy to diversify away from US dollar reserves. Whatever the reason, the impact is clear. Less Chinese silver flowing into global markets means tighter supply everywhere else. It means higher prices for manufacturers in Europe and North America. It means even more pressure on already strained inventory levels. This export restriction couldn't have come at a worse time. Just as demand is surging and mine supply is struggling to keep up, one of the world's largest exporters is reducing how much they're willing to sell. It's like turning down the water pressure when everyone's trying to fill their buckets. The timing has led some analysts to suggest China knows something about the silver market that others are just beginning to understand. They're positioning themselves before the shortage becomes obvious to everyone. Now let's look at another wild development from early 2026. Something unusual happened in January 2026. Silver, a 5,000-year-old monetary metal, became what people are calling a meme metal. If you followed markets over the past few years, you know what meme stocks are. Think GameStop. Think AMC. Stocks that retail investors pile into based on social media hype, creating wild price swings that defy traditional analysis. Silver did something similar. The price spiked to around $117 per ounce. Then it climbed to roughly $120 on Thursday. Then on Friday, it crashed to approximately $78, a 35% intraday wipeout. That kind of volatility is usually reserved for cryptocurrency or penny stocks, not precious metals. What caused this? Social media played a huge role. On Reddit, particularly in communities like Silverbugs, retail investors were documenting their physical purchases, sharing memes, and encouraging each other to keep buying. Posts saying things like, "Bought the dip today, diamond hands," started appearing everywhere. Diamond hands is a term from the meme stock movement. It means holding your investment despite sharp losses, refusing to sell even when prices crash. The idea is that if enough people hold with diamond hands, the price eventually recovers and shoots even higher. This retail investor enthusiasm created enormous volatility, but it also revealed something important. There's a massive grassroots movement of people who believe in silver's long-term value. These aren't institutional investors making calculated trades. These are everyday people buying physical metal and holding it for the long term. The establishment financial media didn't know what to make of this. Some dismissed it as irrational speculation. Others compared it to the GameStop frenzy and predicted silver would crash back to $20. But here's what they missed. Unlike GameStop, silver has genuine fundamental reasons to be valued highly. The shortage is real. The industrial demand is real. The monetary history is real. The meme metal phenomenon brought new attention to silver. It brought new buyers into the market. And it created a community of investors who are educating themselves about monetary history, industrial applications, and market manipulation. That's powerful. Even after the crash, these retail investors didn't disappear. They kept buying physical silver. They kept holding their positions, and they kept spreading the message on social media. This grassroots movement has become a force that traditional market analysts are struggling to understand. We need to address the elephant in the room: market manipulation. Some people hear those words and immediately think conspiracy theory. But when it comes to precious metals, particularly silver, there's actually documented evidence. Let me be clear about the facts. Major banks have been fined hundreds of millions of dollars for manipulating precious metals markets. This isn't speculation. This is documented, proven, and publicly acknowledged. In 2020, JP Morgan paid nearly $1 billion in fines for manipulating gold and silver markets over an 8-year period. The traders involved used a technique called spoofing, placing large fake orders to move prices. So when people talk about silver market manipulation, they're not making things up. It happened. The question is whether it's still happening now. During that January 2026 crash, some very suspicious things occurred. JP Morgan allegedly closed a huge silver short position at the exact intraday bottom of the biggest silver crash in 44 years. The timing was almost impossibly perfect. Add in the London Metal Exchange going dark, HSBC's systems going offline, and a sudden aggressive margin hike from the CME, all on the same day. And many analysts believe this wasn't random volatility. They believe it was an engineered reset, a way for large institutions to cover their short positions before the physical shortage forced prices much higher. Again, I can't prove this, but the sequence of events and the timing raise legitimate questions. Here's why this matters for you as an investor. If manipulation has been suppressing silver prices artificially, then the true price should be much higher. When that manipulation eventually fails, when the physical shortage becomes impossible to hide, prices could move explosively higher. Some analysts point to the COMEX inventory levels as evidence we're approaching that breaking point. While March contract numbers are still over 100,000, the overall trend has been steadily declining. More importantly, the ratio of paper claims to physical silver available for delivery has been climbing to levels that make people nervous. Think of it like a bank. If every depositor tried to withdraw their cash at the same time. Some analysts believe we could see a similar dynamic in the silver market. If a significant percentage of paper contract holders suddenly demand physical delivery, there might not be enough silver to go around. That would force a dramatic price reset higher. Let's talk about price predictions. You've probably seen some wild numbers floating around online. Some analysts are predicting silver could hit $175 per ounce or higher. Are these predictions based on reality or just hype designed to generate clicks? Let's look at what respected analysts are actually saying. Mike Maloney has been asking a serious question. Will silver hit triple digits? His analysis isn't based on hype. It's based on supply and demand fundamentals, historical price ratios between gold and silver, and monetary factors. Other analysts have made specific predictions. One well-known silver expert stated they're expecting silver to perform better in 2026 than it did in 2025, when it gained 147%. They wouldn't be surprised to see silver increase by over $100 per ounce, reaching $175 or higher. These aren't random guesses. They're based on several factors. First, the supply deficit we've discussed. Second, increasing industrial demand as green energy technologies expand. Third, potential monetary crisis scenarios where investors flee to hard assets. Fourth, the unwinding of years of price suppression. But let's be realistic. Nobody can predict exact prices or exact dates. Anyone who tells you silver will definitely hit a specific price on a specific date is either lying or doesn't understand markets. Too many variables exist. What we can say is this: the fundamentals supporting higher silver prices are stronger than they've been in decades. The supply situation is getting tighter, not looser. The industrial demand is increasing, not decreasing, and investor awareness is growing, bringing new buyers into the market. Even conservative analysts who aren't silver bugs admit the setup is compelling. Some suggest that even if silver only goes to $80 or $90, that's still substantial upside from current levels. And if the bull case plays out fully, triple digits becomes a realistic target. The key is understanding that this might not happen overnight. Markets don't move in straight lines. There will be volatility, there will be corrections, there will be days when you question your decision to own silver. That's normal. What matters is the long-term trend and the fundamental factors driving it. Now let's look at the other side of the argument. What are the risks? Let's be balanced here. I've laid out the bullish case for silver. But what about the other side? What could make this whole thesis wrong? What are the risks you need to understand? First, the skeptics point out that people have been calling for a silver shortage for years, some say decades, and yet silver is still available for purchase. They argue that the world has relatively large holdings, making a lasting shortage unlikely. They have a point. Silver is more abundant than gold. It's used in smaller quantities in many industrial applications, meaning it can potentially be recycled. And when prices rise, more supply tends to come to market as people sell old silver items. Second, new mine supply could increase if prices stay elevated. Mining companies respond to higher prices by ramping up production, opening new mines, and expanding existing operations. Third, industrial demand could decrease if silver prices go too high. Manufacturers might find substitutes for silver in certain applications. They might design products that use less silver. High prices destroy demand, which could put a ceiling on how high silver can realistically go. Fourth, the broader economy matters. If we enter a severe recession or depression, industrial demand could collapse. Even if investment demand rises, the overall net effect on silver prices might be negative. Economic downturns are complicated. Fifth, government intervention is possible. If silver prices spike too high too fast, governments might step in. They could release strategic reserves, change regulations, or implement measures to cool the market. We've seen governments intervene in commodity markets before. These are real risks. Anyone investing in silver needs to understand them. Silver is volatile. It's not a guaranteed winner. Past performance, even strong fundamental cases, don't guarantee future results. You could lose money. That said, understanding the risks doesn't mean the opportunity isn't real. It means you need to invest wisely, never putting in more money than you can afford to lose, and having a long-term perspective rather than trying to time short-term moves. Now, what does all this mean for you practically? So after everything we've discussed, what should you actually do? How should you think about silver in your own financial situation? Let me share some practical considerations. First, education is crucial. Don't just take my word for anything. Do your own research. Understand what you're buying and why. Read books on monetary history. Study the silver market. Second, only invest money you can afford to lose. Silver is volatile. Prices can swing wildly in short periods. If you need the money for rent, food, or essential expenses, don't put it in silver. Third, think long-term. If you buy silver expecting to double your money next month, you'll probably be disappointed and might sell at the worst possible time. The people who've made real money have been patient. Fourth, consider physical versus paper. If the thesis about a disconnect between paper and physical markets is correct, then owning actual coins or bars in your possession might be important. Fifth, don't go all in on anything. Diversification matters. Even if you're bullish on silver, it probably shouldn't be your entire portfolio. Balance it with other assets. Manage your risk across multiple investments. Sixth, be aware of premiums and costs. When buying physical silver, you pay premiums above the spot price. When selling, you might not get the full spot price. Factor these costs into your calculations. Seventh, secure storage is essential if you're buying physical metal. Don't leave large amounts of silver in obvious places. Consider a safe deposit box or professional vault storage. And don't tell everyone you know that you own precious metals. Security matters. Finally, stay informed, but don't obsess. Yes, follow the market. Stay updated on supply developments. But don't check prices every 5 minutes or make emotional decisions based on short-term moves. That's a recipe for stress and poor decision-making. Now let's wrap this all up. We've covered a lot of ground today. From the 5-year supply deficit to the paper versus physical disconnect. From China's export restrictions to the meme metal phenomenon. From manipulation evidence to triple-digit price predictions. So where does this leave us? Here's my take. The silver market is at a critical juncture. The fundamental supply and demand factors are unprecedented in modern history. The disconnect between paper prices and physical availability is widening. Does that mean silver is guaranteed to explode in price? No, nothing is guaranteed in investing. But it does mean the risk-reward profile is compelling. The potential upside is substantial. The fundamental case is strong. As for the question posed in the title, when does silver run out? The honest answer is we don't know exactly. It's not like oil, where we can calculate reserves and divide by consumption. Silver depends on mining, recycling, and demand. But what we can say is this: the trajectory we're on now is unsustainable. Something has to give. Either prices rise significantly to incentivize more supply, or we face increasingly severe shortages. Those are really the only two options. My suggestion is simple. Take this information seriously. Don't dismiss it as hype, but don't treat it as a guarantee either. Do your own research. Understand the fundamentals. Make decisions appropriate for your situation. The silver story is far from over. In fact, many believe the most interesting chapters are still ahead. Whether you choose to participate or not, understanding what's happening in this market is valuable knowledge. Thank you for watching. If you found this video helpful, please like and subscribe. Share it with anyone who might benefit, and let me know in the comments what you think. Are you bullish on silver? Skeptical? Somewhere in between? I read all the comments and love hearing different perspectives. Remember, the goal isn't to convince you of any particular position. The goal is to give you information so you can make your own informed decisions. That's what this channel is all about. Empowering you with knowledge. Until next time, stay informed, stay prepared, and keep learning. The world of finance and investing is constantly evolving. The more you understand, the better decisions you'll make. Thanks again, and I'll see you in the next video.